Hey, this is Don Kaufman, and happy Thanksgiving from my family to yours. This Thanksgiving, I'm coming to you as America is feeling the pinch. Gas prices, food prices, they're shooting through the roof. Inflation is officially upon us. But this Black Friday, inflation isn't going to lay a hand on you. Here at TheoTrade, we want to offer you a safe haven from rising prices. In fact, we want to offer you the chance to save money, a lot of money. So here's the deal. Any other time of the year, paying to join us on a quarterly basis would set you back $1,200. Is it worth it? Heck yeah. But it's Black Friday weekend, so let's do even better for you. This Black Friday weekend only, we're going to offer you a truly sweet deal. We want to give you the chance to lock in a full year of TheoTrade for way less than normal. Almost $400 less. Because if you take advantage of our Black Friday deal, you can put us by your side for the next 12 months for the bargain basement price of just $799. And you can wisely save yourself $400. That's right, TheoTrade is one thing in your life that won't cost you more money this year. And we want to do it because the market's in a colossal bubble right now. And if and when it pops, we want to guide you to protect and grow your money at every step. So don't delay. Take this opportunity. Lock in your savings right now while you still can. And we look forward to serving you in the year ahead. Welcome to TheoTrade. This is Don Kaufman, November 26, 2021, doing the TheoTrade weekend up here on a shortened holiday week. Of course, half trading session today. Nevertheless, some fairly wild volatility to end this week. We're entitling, of course, this weekend's update, New Crash or Temporary Market Insanity? I'm going to try to answer that and much more here on this weekend's update. Let's get right to work. I mean, pretty much your entire trading week, and really the last couple of weeks, this, which is a half a trading session here we are the day after Thanksgiving. Of course, Friday has historically been a shortened, it's a holiday trading session. We get 3.5 hours. And yeah, the last couple of weeks, all of volatility basically came down to this 3.5 hour session as traders really rushed for the exit. Now, one of the things I want to extract from part of the equation of, this weekend's update is simply the fact that, okay, there's a new COVID variant. However, one of the things that I'm going to try to point out throughout the course of this update here is that this was used as nothing more than a catalyst for sell-side activity. That when you start looking at it and you start looking at all the different perspectives and some of the asset classes, you're going to start to realize this was less necessarily about COVID and the possibility of more lockdowns and much more about the fact that you had a marketplace that was just this pool of gasoline. All it needed, okay, was one little catalyst to actually spark. And here we are with S&Ps just after the cash close here, down 2.5%. Nasdaq off by 2%. Dow off by 3%. The Russell just gets decimated almost to the tune of 5%. But let's start to actually break down some of these moves and actually, again, try to quantify if this is going to be just some temporary market insanity. As many of you know, I have carried short positions for quite some time. And a day like this, you live for big volatile days, not just as a bear, but also as an individual that has sold premium and continues to sell premium. So as I was saying, traders just rushing for the exits. Now, one of the things, again, to put a little perspective in here that, I think is intimidating to say the least, is that if you look back at a chart, for instance, for the last 3 years inside of the spiders, okay, the only real downdraft that we've had, of course, was caused by the onset of COVID, coming into the unknown. And after that, we simply ripped, and it's been up and away. Some damage was absolutely inflicted, okay, inside of today's trading session. And one of the things that is going to be missed by a lot of people, nobody was paying attention today. really, because the spiders, right, which is one of the most pivotal products out there, traded absolutely monumental volume in 3.5 hours. In fact, it did, double some of the recent trading days, and it only had 3.5 hours, and that did not include the volume from Wednesday night. This was all volume pretty much from today's trading session. Note that I'm not looking at the S&P futures, because the S&P futures, if you did pull up the S&P futures, this included some of the holiday trade, of course, from Wednesday night and Thursday. But the spiders being one of the most pure products in terms of it's an ETF, and this thing was absolutely rocking. So the point of me establishing that is today's move is absolutely real. The next thing, as I say, a little bit of damage was inflicted over here. And everybody, again, they look at this, it's more COVID insanity, buy the dip and buy the dip. I'm going to give you a couple of reasons here where I think there should absolutely be some cause for concern. And I'm going to give a lot of forward-looking statements, because the most important thing right now ain't that the market closed down 2.5%. You push that aside. It's not about the Nasdaq down some 2%. It's about what's coming and what is the marketplace pricing what is coming. Before I get there, to give you a little bit of that feel, again, we're going to look at a couple of different asset classes. Obviously, the talk of the trading community, whether you saw this or not, has been the oil marketplace. Once again, to kind of further the move that you're seeing inside of oil was an absolute, crash and liquidation type event. This is a major, asset that ultimately is down between 12.5% and 13%. So I did have some time to call around to a few friends that sit on risk desks for both TD Ameritrade, which of course, thinkorswim. I also talked to an individual, another major brokerage firm, Tastyworks. All of them are seeing heavy liquidation, predominantly on the retail side. Nevertheless, in that conversation, we also come to the conclusion that there must have been massive liquidation on the institutional side just to see this kind of, again, monumental volume trading in here. When I'm talking about liquidation, it is as bad as it sounds. That is margin calls and people getting smoked out of positions. Margin is definitely going to be shifting at many of the firms, if it hasn't already, inside of a product like oil. So oil, this has already been under a degree of pressure lately. Obviously, the concern here is there'll be more lockdowns. Nobody's going to travel. People, there was already conversation again about the oil reserves, the release of oil, trying to flood the market, no pun intended here. This was that perfect storm in terms of a catalyst to cause catastrophic damage into oil. My concern for oil, extends beyond oil, that this particular commodity can actually start to have a ripple effect at predominantly trading firms and brokerage firms where there's liquidation events. In this particular case, I do believe that if we see any continued sell-side activity in oil, it'll literally start to proliferate into equity markets. Now, what I mean by that, it starts, of course, with oil, then it bleeds over, for instance, the energy sector. The energy sector took on some damage today, but net, if you take a look in the week, the energy sector actually finished the week up. So my point being over here is that oil at this point in time, is definitely an area of concern, but simply because the energy sector itself still sustained gains in the week, we're okay at this point in time. And I wanted to give you a little bit of a different perspective for that one. By the way, one of the most shocking things is the hit that the dollar took. So the dollar down usually helps out some of the commodity products. In this particular case, not even close. That is a really unusual kind of stance for the marketplace. There's some things on the screen that you're seeing today, and whatever. The market's again down 2.5%. And I've been trading for well over 20 years now. I've seen some 2 and 3%. I've seen some 5% moves. But to see something like this, the price action in oil with the dollar getting hit hard, that's eye-opening. There's things on the screen that even after 20-something years, you kind of shake your head at. You're like, that's not supposed to happen. And that's one of them. Onward and upward from there. Capital, flowing into bonds. This is a very disconcerting area. You're going to hear me say this a couple of times on this weekend's update. It's disconcerting because it's one of the larger moves in bonds. By the way, if you're looking at a bond chart, do yourself the favor, you have to contract adjust it. And what that basically means is when you're looking at that bond chart, you have to go over to futures contracts, adjust for contract changes, hit apply, hit OK, because the contract just rolled over. That is, in the previous days, you were actually looking at the December contract. Now we're looking at the March contract. The roll actually happened over Thanksgiving. So here we are. Yeah, the bonds absolutely exploded. And with that, the rates dipped hard. I mean, this is one of the largest recent history, one of the largest rate drops in one day. But that's the TNX, which is, of course, is the 10-year. But where am I going with this? Why does this move make a real difference to me? This is the kind of, movement in terms of, we talk about risk on, risk off. There are risk assets, and then there are places what we term duck and cover. I like to use the phrase duck and cover because it just makes more sense to people. When you rush to bonds, like was done today, and again, you're not going to see the monstrosity of volume inside of the bonds simply because there's a roll going on. Nevertheless, when you rush into bonds like was done today, the damage that we saw to the S&Ps, you have to start to fathom maybe that damage hasn't been inflicted yet. Meaning that the movement to bonds was so fierce, the movement to notes, is so substantial that you should have fear moving into next week. And that's going to be something, again, as I said a moment ago, you're going to hear me reiterate a couple of times over here. Capital is a flowing into the bond market. This is institutional money managers cannot go to cash. People always get that wrong. What do you mean they can't go to cash? Listen, you have a few $1 billion. You can't throw a couple $1 billion in the bank, especially in Europe. They'll literally charge you to hold your money over the weekend. So they flow, into, of course, treasuries, notes, bonds, anything they think is going to be stable. This kind of move is, again, the only term for it's intimidating. It's really intimidating. And I asked that question, is this, new crash or temporary market insanity? This doesn't look like any temporary market insanity. And again, new, which is right now could be a flash in the pan, may not make that difference. As I said, I really think that this is a catalyst for a more substantial market move. One of the other aspects that has a lot of us kind of shaking our heads in really understanding of this, but for the first time, we've actually seen crypto really moving with equity markets here. So crypto, which is, of course, and all the coins took pretty much a hit today across the board, but specifically Bitcoin took almost a 6% hit. Now, these are the Bitcoin futures. The only reason I'm bringing this up, on this weekend's update is simply in respect to the fact that I thought this was supposed to be a hedge. I thought it was supposed to be the new gold. Speaking of gold, it did absolutely nothing inside of today's move. It's the new gold. Why did it sell off with the marketplace selling off? As I said, felt like a little bit of a liquidation event out there. Is it moving with other risk assets? It sold off. Like oil sold off, like any other commodity, if you will, took a hit in today's session. Again, the more interesting thing that has us scratching our heads is you see the dollar down and you've got crypto down. Unusual? Yeah, I think so. Nevertheless, that's something you're going to be watching for in the days to come over here because, again, it lends itself to a more substantial liquidation event, not just a little bit of a flash in the pan. All right, dollar off with gold flat. Let's actually give you a bit of a volatility update. So here are the other aspects that I think are worth mentioning. First and foremost, the VIX, the VIX has one of its highest closes, inside of almost the entire year. The last time that we saw the VIX, elevated at these levels, yes, for a brief and fleeting moment back here in May, but this is the highest close we've actually had since some more serious volatility hit the marketplace all the way back in January. Be very, very mindful of this. It's, again, one of the highest closes inside of the VIX. Does it mean the VIX is going to go parabolic? There's nothing in here, technically oriented, that's going to help you decipher forward volatility risk. I just wanted to clarify that. Yeah, the VIX spiked. Okay, I do have a number of VIX volatility spreads on. You can see my VIX volatility spreads are deep in the money. We'll see how this one actually fares in the days to come. Nevertheless, with 25 days left, positioned beautifully right now inside of the volatility product. But I don't think it's the VIX that speaks volumes. Okay, it's some of the ancillary volatility products. One of them is the VVIX. It's the volatility of the volatility index exploding to the 150 level. Okay, again, all that basically says is that professional trade was out there buying, okay, risk mitigation inside of the VIX itself. Now, here is one thing, again, to further the point that I'm trying to make about today's move. You're like, whatever, man, it was a low liquidity session. Really, it was a low liquidity session. It was a low liquidity session. I'm trying to be facetious with that, people. The VIX today traded what? Okay, a monstrosity of 1.4 million option contracts. Okay, it is on right now inside of the VIX. They were reaching for calls left and right. The volatility exploded in there. In fact, we did 7.6 times, okay, the number of calls traded versus the previous 5 trading sessions. So if you saw something trade 7 times versus the previous 5 sessions, you'd be like, that's you just, the only way to put it, it's monumental size was trading through the VIX. But again, all right, the VVIX volatility bids up, so everybody's reaching. But you would expect people to reach for volatility. But next, you got to look at the volatility futures. And the volatility futures, here's another area that I'd like to say was positive, but it's more disconcerting than anything. And that is, there's some pretty good sell-side activity to hit the marketplace today, but we're still actually dropped into a decent size contango. And what that contango basically means is these December volatility futures, which are roughly 25.90, okay, are still well under. And again, they're well under, all right, those January volatility futures, which are 26.45. Now, I'm actually going to plot this in what's called a depth chart for you to give you a feel. And I'm going to give you a feel for why it's so imperative to understand this. So from charts here, I'm going to cruise over to product depth. So here's a depth chart. What the depth chart displays, you're looking at DEES versus Jan, right? So there's DEES, the 25.90-ish, yada, yada, yada. The point that is to be made in this particular circumstance. And again, okay, whenever you're looking at these curves, things can get a little bit confusing to people, right? And again, when you pull up 9 series, I knock a couple of the series off, okay? The point being over here is a very, very simple one when I put it into context. And that is, you're like, so why are you showing this, okay? Volatility right now in the near term is still lower than it is, okay, further out into the future. First of all, what that basically means is in the near term, we expect risk to actually be a little bit less. As we go further out in time, the risk actually grows. Now, the volatility skew kind of flattened out over here. What this basically comes down to are a couple things. Number one, it means the proverbial, crap didn't fully hit the fan in today's trading session. That today's trading session, although volatile, although the S&P sold off by 2.5%, this could get a lot deeper in. Again, we're still in contango. Now, why the area of concern on my part? Well, the area of concern is simply because it has to do with hedging activity. If these short-term volatility futures, okay, flip over and we go into backwardation. What backwardation would look like is something like this, where short-term risk actually exceeds, if you will, the longer-term risk. That basically means the crap is hitting the fan, get under your desk and rock back and forth at that point. But what happens when we go into backwardation is a lot of big trading firms, okay, they really start to unleash how hedging works, changes when the volatility futures invert. And the area of concern is these volatility futures coming into Sunday night, Monday morning, if they invert quickly, the sell side activity into the S&Ps could absolutely be relentless. I would have preferred if today had closed with the volatility futures inverted or at least flat, because this, again, it lends itself to a very precarious situation early next week. Which brings me to my next point. Early next week. Early next week. All right, Monday is going to be scary. I don't care if you think we're going to rally right out of the gate. We're going to rally huge. Okay, I'm going to tell you right now. Doesn't matter whether you're bullish or bearish. You're going to feel some fear on Monday. You're probably going to feel a little bit on Sunday night. I mean, most of our risk assets, as I was saying, you got volatility futures. They're not inverted. The VIX actually spiked by 54%. You know, the bonds are duck and cover already. All right. Most of your expected moves, we exploded through it. Didn't matter where you were, but most expected moves, you know, we didn't even get into stuff like what? You know, here's the financial sector. The financial sector, apply auto expected moves. This thing just got absolutely like ripped apart. Still ended the week though, almost completely flat. You got to realize that's not good. Okay, that could lend itself to a lot more sell side activity. But here's the real issue is this. Look how big the expected move is for next week. Okay, you look back in any recent trade over here, the expected move for next week is like double, almost triple what it is for most weeks. The financials, it is on. Look at the IWM, the Russell, huge by huge in terms of the expected move. That means the marketplace, okay, is anticipating just wild movement, right? But that's not enough. So why is Monday going to be scary? Because we move so heavily into these, you know, risk-off assets. Again, they bought volatility, they bought bonds, right? They're selling stuff like crypto. There's liquidations going on inside of oil. None of this lends itself to being, you know, happy-go-lucky. It doesn't look like it's temporary market insanity. Temporary market insanity is a flash in the pan. Again, early next week, oh yeah, it really is going to matter. I would put a huge focus specifically into the Nasdaq. The Nasdaq, which actually fared a little bit better than most of the index products. And that makes sense because it's like, you know, during the COVID crash, there were warm and fuzzy places that we could hide, like Netflix, like Roku, right? Like Peloton. But at the exact same time you're saying that, you do realize some of the products that had completely outperformed as of late, like NVIDIA, okay, or for instance, Tesla, they actually underperformed inside of the Nasdaq. And once again, this lends itself like, is there going to be a little bit more of a liquidation event coming to the markets? By the way, Tesla and so forth, it traded decent amount. Like it traded 1 million contracts, which is normal versus the previous 5 days, but we only had half a trading session. You look at NVIDIA actually traded like almost no volume. Nobody wanted to step in and take a lot of risk, okay, inside of NVIDIA. And again, these things lend themselves to the fact that the Nasdaq is going to be downright intimidating. Because as I said, I don't believe that COVID was used as anything more than a catalyst to spark sell-side activity in a marketplace that is just completely and utterly overblown. Again, expected moves everywhere exploded. The rates, that is interest rates, absolutely tanked. It points to dramatic risks early next week. And again, I don't want to make this a hideous, bearish statement for the marketplace, but I think you got to recognize I've been selling premium for a whole lot of years. Okay. I didn't sell any premium per se today. I stepped back and thought to myself, if the proverbial crap's going to hit the fan, it's going to happen early next week, that this actually could just be a little bit of a shot fired across the bow. What really intimidated me though, more than anything, was the SPX expected move. The expected move, here we go. People, put on your big boy pants because in the next week of trade, you're looking at a $154 move in the SPX. Okay. Just behold, because the last couple of weeks, now we just came off of a week. This past week, this is only 3.5 trading sessions. That was a $55 expected move. The week before that was about a $60 expected move. This one's about a $60 expected move. So in fact, what do we really have? It's almost 3 times the expected move of any previous week inside of the SPX. Get ready to rumble. It's one of the greatest things about the expected moves. Okay, not only did we smash through the lower edge of the expected move inside of the S&Ps, but again, we're now looking at triple the expected move roughly for this week of trade. Again, what do you do in a case like this? All right, you make sure that you're comfortable with risk. That's first and foremost for next week. Get comfortable with your risk. And if you're not comfortable with risk, okay, you better get your positions in check. Even when the market opens on Sunday, everybody's going to be watching, right? Again, I believe that risk, if it's going to rear its ugly head, it's coming early on in the week. And also, reminder, okay, you could rally out of the gate and rally huge inside of the marketplace earlier in the week. Okay, that is going to mean nothing. You have a $155 move into the SPX. I believe we're going to see every ounce of that move kind of occur. As I said, it doesn't matter whether you're bullish or bearish. Okay. This is risk is rearing its ugly head. Pay attention right now. Forget seasonality. It doesn't matter. There's no Santa Claus rally coming to a theater near you. Okay. It's on right now. Okay. We've sparked volatility. That volatility is not going to subside overnight. Thanks everybody for joining us for this weekend's update. Have a wonderful holiday weekend. Bye-bye.